Hi, good morning. Um, Thank you. So my name is Amanda Jogia. Can you hear me? Just want to make sure.
Yes, we can
Okay,
hear
great.
you, Amanda.
Great, and I'm the CEO of PrimeAlpha, which I founded 5 years ago, and I want to thank everyone for dialing in this morning on the hospitality panel discussing recovery and resilience. Right now, we are seeing a beam of light with some easing of restrictions, so this conversation is very timely. First, we will start with a short introduction amongst the panelists, followed by our panel discussion, and then we'll open it up for Q&A for the last 20 minutes. So I'll start with a quick introduction on PrimeAlpha. We are a tech-enabled platform, and we work with alternative managers and investors, and we're helping people connect. Our main mission, though, is to promote and educate on quality alternative opportunities and expand its reach. We work with over 800 investor firms and over 1,000 alternative managers across all strategies, including real estate. We think of ourselves as this kind of unique intersection between LinkedIn, eHarmony, and CapIntro. Like LinkedIn, we are a private community of quality investors and alternative investment opportunities. Like eHarmony, we're a platform where smarter connections are made. And we're like CapIntro, but we're non-biased. So that's PrimeAlpha. So at this time, I would like each of the panelists to introduce themselves, starting with Dr. Sangani.
Good morning, everybody. Nice to be on this platform. I'm a cardiologist by profession and turned into a real estate guy and has been in multiple sectors across the real estate. Today's topic primarily addresses hospitality, which is where I started first. As of today, we have, as the slide suggests, about $2.7 billion in transactions. We have about $1.2 billion worth of assets under management and ownership. Some of them are completely 100% owned by us and some are syndicated. And we only do Marriott and Hilton hotels. And then very, very glad to be here. Our investors have never lost a dime in once they've invested with us so far over several decades. And as you can see all those numbers here, we have delivered a 54% IRR at the deal level over the past 15 years. And I think that's very exciting, and we want to continue that. And the opportunities that we'll discuss today hopefully will allow us to proceed in the same direction.
Great.
Hey, good morning. This is Dharman Patel. I'm a managing director at DW Partners, sitting within the commercial real estate group. We're a New York City-based credit fund focused across a variety of different strategies, RMBS, CMBS, with private real estate credit, as well as corporate strategies. The team that I'm a part of focuses purely on commercial real estate, so that's trading CMBS and originating real estate loans that we hold on our balance sheet, all tied to commercial real estate, doing construction, pre-development loans, and other special situation type deals. We tend to focus on all the asset classes, and hospitality, just given all the recent distress, has been a big focus for us. So looking forward to the conversation.
Hi, this is Joseph DiMatteo, President and Chief Executive Officer of JDM Capital Hospitality and Management Group. Our firm focuses on buying, rebranding, building hotels around the U.S. We are seeing this market dislocation as a unique moment, obviously, for everyone. And we're happy to discuss our points of view, strategies that we see, mainly focusing on select service and above hotels. And that's branded, unbranded, boutique. And we have a specific geographic regions that we look at in the U.S. and look forward to answering anyone's questions today in regard to what we do and how we might be able to help provide solutions.
Good morning, everyone. My name is Kevin Amiot. I'm the Director of Food and Beverage for Jesta Hotels and Resorts. We operate hotels worldwide, but I'm in charge of the South Florida region, including the Clevelander Hotel and Shuckers Waterfront Grill, Best Western, Styles, Essex Hotels. I'm the operations guy, and looking forward to discussing all the new challenges with the new sanitation and cost controls and then guest perception of how we're going to handle this moving forward.
All right, great. Thank you, everyone, for your introductions. So let's get started with the State of Union on hospitality and touching more on kind of the demand recovery side. I would like to ask the panelists to give their assessment on the current hospitality environment and where they see or will see recovery. And we could start with Dr. Sangani.
Good morning again. The hospitality sector is probably one of the most hurt segment with restaurants and do not know where the end is. And whatever opinions I'm going to give today are for discussion purposes primarily, because there's always pros and cons and always different opinions. So this is not etched in stone, but something to discuss. And then if somebody has more questions, please reach out to me and we can discuss more. Because of the time constraint, I'm going to limit my opinions to certain certainties, which may or may not be that certain. Having said that, the last time when Glenn Peterson, who runs our hospitality division, and I sat down, we felt that if something is not done on the debt side, about 40 to 60% of all the CMBS debt or other debt would be in default if this continues for more than 3 months or so. So PPP will only last for so long. The debt is the biggest component. When the occupancy hovers around 10, 15, 20%, the signs are not that exciting at this point. We wanted to close a deal last week, and the last minute, and then we usually have a good credit and good situation with lenders, but all the lenders went away. So it's very hard to find debt at this time. And lenders are working with us, but at some point they will also have significant problem surviving. So all in all, I'm not trying to paint a very, very sad picture, but hospitality overall on a 30,000 feet view does not seem to have a lot of legs to stand on its own. Having said that, what is the solution? And what are the opportunities? And I don't know whether this is the right time to discuss or not. So should I stop here or should I discuss that or take it on the next question?
You were talking about the debt component too. I don't know if, Darman, if you want to interject in terms of what you think about in terms of the assessment of the hospitality environment and touch on that debt component.
Yeah, absolutely. So, we have substantial exposure to the hospitality debt sector through some CMBS holdings. What we've seen over the last 2 months or so is that, a majority of the deals are transferring into special servicing. And just adding on to what Dr. Sangani said, borrowers are starting to look beyond what's going to happen once they deplete their PPP funds, and a lot of the requests that are coming in, have to do with seeking some near-term forbearance on interest payments. And look, us, along with the special servicers are trying to be creative in terms of how we do that without hurting our bond position in any way. And a lot of it has been, getting creative around some of the reserves that are held at the property level and potentially using those, instead of things like CapEx and FF&E, using those to cover some of the operating shortfalls. And it's going to take a jointed effort. And I think a lot of it comes down to, what some of the lenders and bondholders incentives are, right? Where, if you have a group that's seeking a more opportunistic strategy where they're trying to, eventually take over the asset through the debt, you're going to get a little more compliance versus a group that's, truly playing in the debt space and looking to maximize the recovery. So it'll be interesting to see how, things sort of play out over the next few months as this continues on.
Right. And Joseph, can you give your assessment on the current hospitality environment as well, and your assessment on
Sure.
the recovery?
So it's a few different things. One, I think there's going to be buying opportunities. There's going to be opportunities that are busted that need strategic and technical knowledge that's just not in common reach. What I mean by that is the toe in the water and dabblers who, let's say, have 95% of their holdings in residential and have one or two hotel assets and not the infrastructure or knowledge base of what to do to navigate, are going to have an even tougher time on the extreme side. And I think that the center point of that is going to be definitely what the lenders decide to do on one side of that. And I think the other side is going to be the macro industry. You can't ignore it. I mean, hospitality in itself is powered by and encompasses, the airline industry. We're looking at a very possible teetering to complete reset bankruptcy of every major airline who's out there. That is going to impact travel and the hospitality industry, because that's the support system to bring the guests to the destinations. So you have a macro global issue in regard to worldwide travel. So then you bring it down to the US base. What's going to happen on the US based side, and what we see already, is that's going to be heavy drive market business. So you're going to see a difference in how people travel, what happens at their guest experience, what happens when they're in the hotel, even down to the cleaning of rooms, where you're going to have lockdowns where it's like, okay, you're not going to have everyday cleaning. You're going to have you're going to be shuffled around if you need everyday cleaning, or you're going to have these periods, because we are examining different certifications processes to be able to open the assets and make sure that they're functioning correctly. But from the macro aspect, we can't ignore all the other pieces that touch it. And travel through the airlines is going to be a major impact. That also goes back into group business, which was already impacted and suffering previous to this pandemic, and shifting and changing. To look at us now, right? These conversations are all being done on Zoom and so forth. What does that mean for the large scale hotels? And the final piece is that, one of the things I wrote on my JDM Capital Hospitality Management LinkedIn page, it's, larger hotels are going to have to figure out how to do experiences in smaller ways. And I think that the limited service area is going to get crushed, because they're just not suited financially to be able to handle the additional costs that are going to be impacted on them to be able to provide, safe places for guests to be able to reside. So I think that there is such a shuffle happening and a redefinition of how the industry gets their guests, what the guest experiences are, and the last part is going to be what guests are going to be willing to pay for. You may see people a lot more campfires and tents than you're going to see them at the Ritz-Carlton. So, though an extreme concept, but it would get you to the middle.
Right. So in terms of, the demand recovery, pickup levels and type, winners and losers, if there's a second wave, how will that impact? And how will hospitality get ready for that? Because we're easing at this moment, but as it's in many countries, there tends to be the second wave. How are we impacting for that, since there's some easing now?
This is Joseph. I think that from that side, in regard to what's going to happen if we do a double dip, it's going to be more than just the hospitality industry that has to worry. You're going to have municipalities that depend on these hot taxes. For those of you who don't know, hotel occupancy taxes, which is really going to bring a spotlight on this Airbnb business, which is effectively, an easy way to duck the hot tax. And I think that it's going to be more painful for, again, limited service, definitely Airbnb, Absolutely. Their ability to be able to function is going to be tremendously impaired as this thing gets pared down because, again, safety standards, taxes, municipalities being hurt. I think that we're going to look at a complete reset of our entire economy if it's a double dip to the extent that there is. You know, hotels are going to become, you know, in impairment places for, you know, additional hospitalization, no services. It's going to be, you know, a traditional 20% occupancy to function on a hotel. You know, you're not going to have 4 people at the front desk. You're going to have 1 person and maybe an iPad.
Right. Just turning to the recovery and the operations component to it and the stabilization and reopen. Kevin, can you talk a little bit about what people have done to get ready, you know, to get restabilized in this time?
We're in the process right now of getting ready to reopen a couple of our restaurants in the next 2 weeks, and we're going through screening all our employees and all our vendors every day. And we are actually going to test all our employees monthly for COVID to try to get that guest perception that we're going above and beyond to all the new regulations. And the regulations are changing daily. Every day we get something new we have to deal with. So we're adjusting as we go. Obviously, it speaks to increase of costs, as Joseph stated earlier, and someone's going to have to pay for it. I mean, things we're doing to control our costs are the management team that is coming back is everybody's staying at a 20% pay cut. The majority of our labor is going to try to keep them at part-time to avoid full-time benefits and control those costs. And just temporarily until we see if this is going to go back or we are going to get a second wave. And I think it's critical that we watch the food market pricing because the markets, with all the plants closing and other things, we have to be able to adjust our menus. And that's another thing. We're using throwaway single serve menus. So it gives us an option to adjust daily if we need to control our food costs. We have to look at all those items every day to even produce a profit. I mean, some of the smaller restaurants probably should not even open because they're not going to be able to make money. They'll probably cost them more than staying closed. And I think guest perception is a huge part. And I think that has to do with the social media aspect as well, that the social media will become a sounding board for people that aren't doing the right things with sanitation wise and ever. We're going to the steps to every 30 minutes, the timer is going to go off and they're going to radio everybody and everybody has to stop and go wash their hands. And even if they're taking an order at a table, they have to walk away to have that guest perception that we're doing the right thing. I mean, there's a lot of things. We're placing hand sanitizers pumps on every table, extra hand sanitizing stations throughout. We're closing the bathroom every hours for cleaning and sanitizing. There's a lot of extra things that we have to do to protect us and protect our guests to make sure that we can make our business successful again.
Thank you.
This is Joseph. Just if I can make one add-on point is the concept of how dependent, you know, every, let's say, select service above hotel that has a food and beverage outlet in it, that revenue is effectively, you know, gone till further notice for most hotels to be able to operate because there's variances. You've got places that have 5 outlets in a hotel, and one that has 1, maybe 2, and how they're going to be able to service those clientele. And the guest perception is going to be definitely changed. But one of the things that, you know, that even Dr. Singhani mentioned in regard to, you know, these food and beverage outlets and how they're going to be able to look at things and what I think it's going to change that guest experience and what a room is going to be. I'll take it a step further to say they're going to want to control some level of their food supply where maybe you have hotels like we have, you know, accommodations that have kitchens and have, whether it's a small kitchen or a large kitchen, definitely refrigerated. People are going to want to look at having that supply chain themselves and not necessarily dependent vertically. You're going to have a split guest experience. I don't want to touch anything anyone else touched. I don't want to be with anyone else. I got 4 kids. I want to be able to stay here. it's going to be a shifting change in that balance is also going to change the hospitality's ability to cater to those needs in the infrastructure that exists, which is going to require more money and also more assistance from the debt market.
So based on all those parameters, what segments, I would love to hear from each panelist, do you think will be, winners or losers out of all this? And also in line with that, maybe also who will recover faster?
So if I address that question, let me divide that into a macro, global, and micro situation. On a macro level, the solution to 40 to 60% insolvency or inability to pay the debt, etc., can be resolved, and which most likely will be resolved, is by government feds telling us we do not need to do mark to market. And they did that in 2009. And I know we all have really painted a very negative picture of what the hospitality looks like right now. I also want to take people on the other side. And if I can take just 2 minutes to do that. So one, on a macro level, if mark to market is gone and people, unless they try to sell, there is no reason to value the asset, then most of these defaults, the covenants will be met. And then only people who cannot do the debt service payment would be the only people who will be affected, which Fed will come up with, whether it's Main Street lending or whatever other criteria. So I am very, very positive that that is going to occur. It did occur in 2008, 2009. It will occur now, especially after Powell's interview on 60 Minutes. It was very refreshing that what Feds did in, I believe, in 18 days, it took them 18 months in 2008, 2009. So kudos to where we are in the world and where the government, there's always criticism here or there, but overall, I think the economy has been held fairly okay at this time. Now on the micro level, listen, the issue of people going to hotel is never going to go away. When Airbnb came, when other kind of concepts came, we all felt, oh my God, we are just going to get killed. That didn't happen. The RevPARs continue to go up, the hotels continue to build. In fact, the last 2 years is the highest level of new development, commitment, and opening in the entire century. So all these threats come and go. The resiliency of this industry, and by nature, people just don't want to stay at home. And just think about it. Who is now looking at the number of deaths like we were looking 6-8 weeks ago? Very few people, right? And then that's because we are all tired of being at home. I'm in Dallas right now. I was in Mississippi last weekend, and people are out there. So coming back to your question, drive to markets will be just fine. We have a hotel presence in Daytona Beach, and I was just telling everybody yesterday that even in April, when across the board to have a 10% occupancy was a winner, there was a 70% occupancy at a ADR of $150. So as long as there are drive to markets, they'll be winner. People are going to change themselves somehow to cater to drive to market. The recovery where it will be markedly affected is again where there are the highest level of deaths and the lowest level of recovery. And for those, you just need to look at the gateway cities, New York, LA, Miami, San Fran. All these places are just not going to be able to accommodate people as fast as what Dallas is doing right now or Austin is doing right now. So I think those people will do just fine. And last, Joseph mentioned the airline. The airline is really is the one that is not only going to determine the how quickly the recovery is going to happen, but is also going to determine, in my belief, although just remember, I'm a cardiologist, not an economist, just my views, is the last 20% of the economy is fully determined in the United States because of airlines. And that 20%, if that doesn't come back fast enough, we are not only looking for hospitality difficulties, we're also looking for a recession that is going to be difficult to fight hard in spite of all these things that's happening. So my concentration is what can I do to enhance drive to market, and what can I do, or how can I watch airlines get better? The Moderna thing yesterday was a great relief. If the vaccines come up faster, it's great. And you also probably, some of you know that we are also the largest Five Guys and burgers and fries franchisee in the country. Restaurant, as far as the predictions go, probably 25% of the restaurant are going to shut down as per the biggest app that is out there. But also let you know that Five Guys where we are at, even shut stores, only delivery and takeout, we performed 75% of the budget for the entire country because we have about 100 Five Guys stores. So I just want to also put some silver lining to the dark clouds that we've been talking about, and I'm going to stop at this point.
Thank you. Let's turn to price discovery and transaction activity going forward. I'll pose this to Joseph. When in your view will we start to see the market start to trade for assets? How long will it take for the owners of assets to adjust the price of the assets given the frothy days for asset prices prior to COVID-19 that are still a recent memory?
So there's layers to that. So the first layer is you have the difference between 08, 09 and now is beyond a natural recession caused by human decisions and transactions and overzealousness of mortgage-backed securities to support that to happen. This is out of human hands. So what I've seen and discovered is that servicers and special servicers, for the most part, have been accepting and in a paradigm of working together. So no one's looking to kind of break the buck. I think that there's an important factor that Dr. Sadani said before in talking about the mark-to-market factors. But big picture is that the debt markets have to have a relief either from whether it's a governmental intervention, something has to happen in order to give a floor for that to be able to start to get some pricing levels. You've got now, big M&A, big deals generally ripple through to what's happening on smaller deals. We don't know the specifics of why something happened, but the news broke that the Diplomat Hotel in Florida is not trading. That's an $800 million deal. That was a $1 billion deal that was just announced, got into the public today. That is not happening. And I think that is a ripple through of not just showing it's showing, as has been discussed on the call, banks pulling back. So the support of banks not being in the market is going to drive value down because the inability of leverage is going to increase the need for equity and therefore directly increase the risk profile and return anticipations of that equity. So again, the complexity of a hotel being a real estate asset with an operating business inside of it, and knowing how those pieces function independently and collectively together, there's a finesse and a nuance to it. But knowing the equity markets and how much money has to go into that, the returns are going to be outsized in regard to the anticipation of people stepping into a problem. Again, it's if you're building and you're going to be looking for a reduced basis, extremely reduced basis to what you've seen, and the benchmark is going to be against the test of where basis was in 2019 to that current purchase price. If you're going to buy something, it's going to be tremendously discounted off of what is going to be near-term stabilization, and that's going to be also showing a longer-term curve of where equity has to have an anticipation. There's no 12 months now. There's no 18 months now. This is now a 3-year workload with a 5-year starting to 8-year recovery rate. So it's that big in this type of piece of the industry, and it's not a death to optimism. It's a realization that people have lost their jobs, that they've exhausted their PTO, they're using their their savings to survive. They're in a position where, you know, their time off is not there because they don't have a job. So that's the leisure side. The business side of travel, the road warrior, you know, that's like, you know, what's going to happen to those guys? You know, and now the last piece is the leisure piece. That's going to be interesting because people are starting to get used to remote working. Again, changing the needs of the actual physical asset. So pricing is going to be able to be driven, and valuations are going to be driven by day one value play. Can I buy it for $150,000 a key? Can I build it for $90,000 a key? Can I, take it and add in $30,000 a key? You know, build, break, bust. What is the concept of that overlay and that timeline of where it's going to be coming back to stabilization on the other side? So hopefully it gives you a little bit of a path of where it is. It's going to be it's going to be asset location specific, not a complete tarring of the entire hospitality industry.
Right. Even with the fact that there's so much capital out there, people are being very
capital. I think the capital that's out there is anticipated to be putting in 10 to 25%. When the capital's out there and they're going to put in 40 to 60% to get financing, I don't think that anyone's book, fund, REIT is underwritten that way. Well, let me say REITs. REITs are traditionally supposed to be lower leverage, and that might give them an edge. But the concept of how the fund and the equity returns, it's going to change the whole hurdle concept. So that's why it's the first test is going to be on value. It may be, more cash plays to be anticipated. Again, more equity. But I don't think and that means it's going to change the amount of assets that these funds are going to be able to take into their portfolio. It's going to be reduced. It's not going to be X dollars over 20 assets. It's going to be X dollars over 10 assets. So it's going to drastically change the buying power that is even dry power that's out there.
So Amanda, if I can I interject for 1 second?
absolutely.
So it's very interesting, and Joseph made a very good point. Just think about this. Warren Buffett, he's sitting on $125 billion cash. And normally this is where he really excels. Whenever the downturn comes, he sits on cash and makes huge acquisitions. Guess what? He has not done a single acquisition, as far as we know, out of the $125 billion. What does that tell us? It tells us that the situation right now is so muddy that nobody even knows what it means. If there is no cash flow, if the hotel occupancy doesn't come back, and if there are no lenders out there, where are the transactions and how are the transactions going to happen? And they are not happening. So to answer your question a different way is that the transactions are all shut down at this point, and it cannot come back till we come back and say we can project something. And I don't think the projections can occur till we have either a cure, which I'm a cardiologist and a physician, so I can tell you it's a viral infection. There is really no cure. So that means a vaccine development. So if I was a buyer in the market right now, I would hold tight for next at least 3 to 6 months till December, I would believe, before any transactions, meaningful transactions, will take place, because all the pieces that put the puzzle together are so disrupted that there's nothing to put together. Just my thought.
Thank you. So,
Hey, this is Dharman. You mind if I just jump in quickly? A couple things to add to what Joseph and Dr. Singhani said. Look, I think there's one avenue where we are going to see a lot of transactions, and we did see a lot of capital get put to work, which was in the secondary debt market. As everyone had mentioned, there was a massive run on CMBS. A lot of these hotel assets have been levered with borrowers having cashed out a significant amount of equity. And you're going to start to see a misalignment of interest where for a borrower right now it might not make sense to keep on plowing fresh equity into a deal even if they have it available, because they're so levered and there's so much downward pressure on values. But what we have seen is a lot of the private equity players, which were typically involved on the equity side, got super active buying debt during the sell-off in March, and those are the types of guys that are geared towards being able to eventually take over the equity and get control over these assets through some of these debt tranches that they bought at significant discounts. And to me, that's really where you're going to see a real wave of assets switching hands, right? It's not necessarily going to be sales in the open market just because valuations are so difficult to underwrite, but it's more going to be the debt buyers that can step into the equity because they were able to get in at substantial discounts during the big sell-off in March.
No, that is absolutely correct. And I do agree, if I didn't make it very clear, that buying the debt is probably going to be the largest play. But again, it goes back to market. If the government changes things to market, then only people who will default are the people who cannot serve the debt at this point. And it's not as bad. Like last night, we had a 32% occupancy across our portfolio. And we are in almost 8 to 9 states with our hotels. So I do believe that this is a great opportunity to buy debt at a discounted price. I just don't know when and how much would be available, but it's a very good point.
Great. Hey, Dharman, can you give a little bit more, and just since we're on the security side of hospitality space, talk about CMBSs, and maybe you could also touch on equities and REITs, but maybe just talk about getting exposure to hospitality through public markets, and maybe public versus private markets as well.
Yeah, absolutely. Look, I think the bigger opportunity on the debt side thus far has been in the public markets, because a lot of the mortgage REITs and mutual funds that bought a lot of the CMBS deals at origination, used substantial repo leverage, and when they met those margin calls, the first thing that they got rid of were their securities as opposed to their private real estate debt, just because that tends to one, be able to move quicker and just have better liquidity in the marketplace. And what we saw was, a lot of bonds that were trading at par in Feb, trading now down to, 50, 60 cents in some cases, especially in the hospitality sector. And you had a broad range, some of the trophy assets with the strong sponsorship, like the Blackstones of the world, traded at less of a discount, but also rebounded very quickly. And then some of the pools of the larger, select service, limited service hotels, you're still seeing that stuff lag the rest of the debt market a bit in terms of its recovery. But certainly there was substantial demand for hospitality bonds, throughout the spectrum of assets, and we've seen it rebound very nicely, which is a bit surprising, because I do think to the extent that there is a second wave and things don't come back as quickly, you will see a second wave of assets transferring into special servicing. So it'll be interesting to see what happens to pricing at that point. But a lot of the buyers were stickier private equity type guys that won't have the same pressures to sell as some of the funds did in the middle of March.
Got it. I want to make sure we have enough time for Q&A, so I'll pose the last question. What are the key attributes required for investment success in the hospitality real estate sector that investors should be looking for in general, and anything you might like to emphasize that's related to the recovery now?
I always maintain this in all my talks, and it's no different, and it's probably more true during this time. For real estate investment and to have a good night's sleep, number one is low leverage And number two, significant cash reserves as working capital, and everything else will fall in place. Since we are running out of time, that's just my 2-cent version of staying safe in this crisis situation.
Great. Joseph?
I think that it's important to have an active plan as much as possible in regard to, channeling out all the complexities that exist in hospitality, be it operations, finance, accounting, what you're doing in regard to these things. Operational know-how is more key now than ever. And I think that you have to be on your toes in regard to being able to react to what's happening governmentally within the industry, and developing a plan even as you're standing still in the asset, taking advantage of these times to clean up, reorganize, whatever you need to be able to do, but try to start thinking in a 5-year plan from where you are today. Again, as much as it may be difficult to say, over the next 3 months, like we've all said on this call, and Dr. Scani said very good, it's like, the waters are very muddy. The crystal ball is, right now, one of those magic 8 balls, right? You could shake it and ask it what it wants, see where the answer comes up. But I think the idea is that you have to look beyond the curve in the road at the moment and start to have plans for the assets of what you're going to do next to respond to the greater needs and demands of your guests, of your investors, so that they're well informed, and whoever's coming in today understands everything that we're doing current, tomorrow, today is long term. This is not going to be, a quick fix. I agree that, it's going to be a shorter plan of assets stopping and not trading for the next few months. But I think that if you don't have a longer term plan for the assets and knowing what you're doing in definition operationally, you need to partner with someone who can quicker than you're thinking.
Hey, it's Darman. Just from a debt investor's perspective, I think our key focus always has been, and definitely will be more so through this, is just, basis and sponsor quality, right? Just as the market starts to evolve on the hospitality side, we don't know what type of margins operators are going to be able to achieve. So, making sure that we're at a substantial discount sort of provides us with the flexibility to do what we need to do in a distress case, in order to cover our exposure, and to, I think, sponsorship, just operational expertise, and knowing that your borrower has substantial equity that they're going to be willing and able to protect, is a huge alignment of interest, and certainly provides some real downside protection.
Great, thank you. So I'll open this up for Q&A. We're getting some questions in. So Dr. Zangani, you're getting a lot of questions about sanitization and cleaning standpoint. Do you want to touch on that a little bit? I think that'll be really helpful.
Sure. First of all, this is not a negative comment. Yeah. Sanitation with virus or without virus is a good thing. But let us also be realistic. The virus, and there is some difference of opinion, but in general, they die if they don't find the mucosa of the nose or the eye to get into the body in about 15 minutes. They are saying that the COVID probably lasts for 30 minutes or 35 minutes, but be as it may, it doesn't take too long for viruses to die. So sanitization, you keep doing it, it's really not that important from any additional reduction in death perspective. Also, one has to remember that just because you got the virus on your body doesn't mean you are going to have the disease. You have to get close to your eyes or your nose to transmit that virus from your hand or wherever it is, from your clothes, into the mucosa inside the nose, so the virus can find its way inside the body. And third thing is, listen, even if we got coronavirus, my brother-in-law had it, and one of our important hospitality member who travels all over got it. Doesn't mean it's the end of the world because 80% or plus, I mean, these numbers are debatable, but as a physician, I still believe that 80 to 85% of the people are asymptomatic or mildly asymptomatic. So sanitation is good, but please don't kill yourself over sanitization, because sometimes too much of those things can also make your immune system and affects your skin much more. If you keep washing with all those detergents and every 15 minutes, could be very, not very dangerous, but could not be a great thing for you. So now, having said all those things, I cannot take away the importance of wearing the mask. Mask is one solid way of not letting anything enter in your body. So I would encourage, if you have any questions, doubts, worries, please select mask over sanitation or anything else in this world except vaccine 100 times over. Thank you.
Great. We have a question from Daryl Crawford. It's a fun one. I'll pose this to you, Joseph. Using your crystal ball, how would you each look at 1.1 billion hotel casino build on the Strip in Vegas with one keys, 50-50 for sale condos, regular hotels? As far as timing, considering a 2.5 to 3 year build out, when would you start construction?
As long as there's an ability to, what do I think about it, or what do I think of the timeline? I'm just trying to make sure it's a pretty big question.
I think what do you think about it? Also, when would you start construction if you were to do that project?
So you're built. So here the question is, it sounds like to me is, when do you start building for the next cycle, right? So I think that those are supply and demand and value questions. So if you're building today and you can be able to have a reduced basis into the project, I think you can be able to have a safer outcome. If you're going to be able to buy the project cheaper because you believe that you could be able to do it now and get those prices locked in for the next 3 years, and you have an aggressive assumption on inflation, which is extremely possible. It's something we didn't really touch on today, but it's something that is in the backbone of everything here, that the way that, municipalities and businesses, we touched on it a little bit when we said about what the costs are going to be to the guests at the end of the day. It's going to be, you have an inflationary factor. So you could take the viewpoint that you could be able to buy the job cheaper today, that you could be able to come out the other side and make a reduction in basis on that acquisition. But you have to have a better skew on what the current changes are going to do to the supply in the next cycle. So that comes back down to the operational side. So in that operational side, you could wind up having, again, a real change in how rooms are cleaned. California itself has a whole thing that there's lockouts. You go, you clean the room, no one comes in until the person leaves, meaning that they're checking out or there's a changeover. That means they could be 1 week with their own sheets. No one else goes in there. The rooms are sealed before you enter back in. So there's no one other than the person who's the guest entering that room after it's been fogged. And that's going to be a change, because now that's going to lend an impact to occupancy and supply, because you are not going to be able to change over the rooms as quickly. You can't have somebody waiting downstairs when you got to still fog 3 rooms. So if you have a viewpoint of something as Vegas, and again, I'm not a person who's in the gambling side of the world or knows the casino business or has any desire to, but I think that the supply and demand factors, your pricing and your basis, are going to be what drives that key decision. But that's a tall order for $1.5 billion of new product into a market that's still trying to figure out what's next.
Great.
In other words, please stay away from new construction today, especially in the gateway markets or the markets which are heavily affected by COVID. That's a summation of everything that Joseph really explained, and then you go back to the planning board.
Excellent. Yeah, just one other thing I would just throw in there is that something like Vegas has an entertainment impact. so how people even go to movies, how people are going to gamble, which is technically entertainment, how people are going to go see shows, the entertainers, all that stuff. So first row seat might be 20 feet back now than it was beforehand. So all those things of how that interjects, because it's not just strictly a hospitality play. And back to travel, as that's the guy who said in regard to how people are even going to get to these gateway cities.
Right. That's great. Are there any more questions? Because I have a question as well. I'd love to get each one of our panel's perspective kind of on what they think is, the next 12 months. I know Dr. Sangani had talked about Q1 2020 as a kind of a recovery phase for certain types, but just kind of your outlook for the next 12 months. And then just kind of thinking about how, as investors, we might think of, hospitality within our portfolio, whether it's equity investments or debt investments. I think that would be great.
So if I go first, I am strongly positive, and primarily because of what the Feds in the Congress has been doing. Otherwise, I would say it would be at least 3 to 5 years before we would get there. But because of everything what we are doing, and I'm assuming that the mark-to-market situation will be resolved, I personally do believe that the first quarter to second quarter, we should have a significant amount of recovery. Whether the pricing and the cap rate would be the same as they are today, that remains to be seen. A lot of that will depend on rest of the sectors evolving and how the overall situation across the world plays out. But I'm very optimistic at this point. Just seeing our hotels going to 32% occupancy last weekend has made me a strong believer of that we are really doing great to resurrect this economy. Thank you.
Thanks. Darman?
Hey, sorry, can you hear me?
Yep, I can hear you.
Sorry, cut out. Yeah, so just to add to what Dr. Sangani said, I think we think there's over the long-term horizon definitely going to be a substantial bounce back. I think we're trying to be very mindful and defensive when we think through a volatile sector, and I think this is just an asset class where it's tough to say how things are going to evolve over the next 2-3 year horizon. And I think the industry is going to be totally reshaped. So, we want to be very mindful in thinking through the impact of that and just maintaining an abundance of flexibility in any new investment that we make to be able to handle a shifting landscape.
Great. And Joseph?
I think that it's the stuff that we hit. I don't think that for me, I think it's pretty static. Versus going on, I think I echo everyone that was on the panel and what they said in regard to what's next and how that's going to happen. So ready to see what's next and keep everyone updated as this market evolves. Here to be able to help and be a solution for those problems as they come up and work along and partner and co-invest with those opportunities that are ready and ripe to be able to move to the next level.
Okay, great. We did get one question that just came in, and I think it's a good one. How is this crisis different than the 2008 Great Recession? From Adam Greenfader.
I mean, it's fundamentally different situation, right? The 2008, number one, there was a bad boy. There is no bad boy this time. There is no residential crisis. There is no debt issue. Banks are much stronger. They didn't lavishly spend the money. So that's number one. Number two is Feds have really responded much faster. They've learned from their lesson. Like I was suggesting, they did few things in 18 days that took 18 months from before. And third is the underlying economy continues to stay strong. So all of those things makes it a whole different animal than what it was in 2008, 2009, I believe.
All right. So anyone else?
I think I touched on it earlier, and again, Dr. Singani definitely, echoed what I said in regard to it. I think that the economic factors, the only big piece that I would add on to that is that this is a step towards, in a certain way, deglobalization. To the extent I'm talking about is that where you have this interdependency of international and foreign supply chains, I think that there's going to be a re-examination of how product, food, supplies, key supplies are sourced, and what it's not going to be just about money anymore. I think that there's going to be a different concept in regard to whether it's, as we've seen and watched on the news, and ventilators and so forth. That's a big example. So I think that because travel is going to be limited, especially in the near term, because Europe is in still such a disarray, the dependency on supply chains and what the breaks in those supply chains are drastically different to 08 and 09, where there was a bigger risk in 08 and 09 for a momentary second that we could have had hyperinflation. This is a different economic engine that's going to push things in a different direction. Not just the needs of hospitality, it's everything from food supply, equipment. Look what's happened in the oil market. Why? People weren't buying, people weren't traveling. The commodity costs, the acquisition of those things, and the labor that's going to take to get them, you're going to see an echo perhaps of what you saw since the 80s of made in the USA and people looking for that. So that's a big next step in regard to 08 and 09. Globalization's probably what saved it, and you were able to outsource inflation. And that's the greatest benefit of what China gave in the last 50 years of being part of the U.S. economic engine. We were able to outsource and de-emphasize our inflation. That's a big, major mountain in the middle of the room no one's talking about yet.
Great, thank you. So that concludes our panel discussion. I want to thank Kevin and Joseph, Darman and Dr. Singani, and of course, Michael Athlaya. This has been a pleasure for me. It's my first time moderating for this venue, so thank you for the opportunity. And if there's any questions, I'm sure Michael and his team will coordinate.
Absolutely, Amanda. Thank you very much for moderating the panel. Thank you to all the panelists. Exceptional panel. I wish you all the best of luck. And, I want to welcome